Good evening. Mark Teran, your mortgage man since 1986. Tonight, we're going to go over debt to income ratios and explain them and the impact it has on housing. So let me get started by sharing my screen. Okay, so tonight's topic, debt to income ratios explain the impact on buying a home. So first off, what is a debt to income ratio? It's the percentage that shows how much of your gross monthly income goes towards paying your debts. And it's a tool that lenders use, and they have guidelines that they go by. So you need to fall within certain debt to income ratio guidelines. To calculate that debt to income ratio, what they do is they divide your gross monthly qualifying income by your monthly debts. Or your monthly debt payments, I should say. So, for example, let's say that you had $3,000 a month going out for your house payment and maybe other monthly debts like a car payment, things that would come up on your credit report. Let's say that's $3,000 a month. And let's say that your gross income is $72,000 a year, which is $6,000 per a month. So 3,000 divided by 6,000, we get a 50% total debt to income ratio. So it's calculated as simple as that. And so there's two types. There's what's called a front end ratio, also known as your housing ratio. So in that example, let's just say your house payment with principal and interest, property taxes, homeowners insurance, any required mortgage insurance, and if there were special tax assessments, or if there was a homeowners association dues, all of that would be added up together for your house payment. So let's say all of that totaled $3,000 a month. And in this case, let's say your gross income was $6,000 a month. 3,000 divided into six, excuse me, is a 50% total housing ratio in this case, which would be considered rather high. Now, the second ratio is your back end ratio. And what that is, that's going to be your anticipated house payment, everything that we just went over that comprise that house payment, plus other monthly debts, which are normally ones that would come up on your credit report. So we're going to be looking at, let's say, if you had a car payment, we would include that. If we're looking at revolving debt like credit cards and whatnot, you'll find that your loan officer is going to ask you, well, what's your minimum monthly required payment on that? You might actually pay extra, right? Let's say you owe $3,000 on a credit card and your minimum monthly payment is $50 a month, but like, oh my God, I'd be 100 years old before I ever paid it off. So you're paying double, you're paying 100 a month. But when we go to qualify you, we want to know what the minimum required monthly payment is, because that's going to help us in the qualifying. That the lower the debt to income ratio is, the more well qualified you are for that loan. It's really a cash flow analysis is what the lender is doing. So that total debt to income ratio is your house payment plus the other monthly debts that would come up on a credit report. Car payment, maybe you have student loans, and we're going to have to use a payment for that. I know some of them are deferred, but a lot of our guidelines still require us to calculate a payment for them, just as an FYI. And credit card payments, we want to use the minimum monthly required payment. So you're going to add all those up. And let's say we've got 3,000 plus another $300 a month. So I've got a total 3,300 going out per month. And let's say our gross monthly income that we can use for qualifying is $8,000 a month, right? Or $96,000 a year. I'm going to divide 3,300 into that 8,000, and I get a total debt to income ratio, or back end ratio as we call it, of 41%. That's how that's derived. Now, when we get into doing home loans, there are standard ratio guidelines that lenders use. And if you're an old fellow like me, on regular conventional loans, which you've probably heard Fannie Mae and Freddie Mac, they kind of set the standard conforming loan market. In my area, Sacramento, Placer, El Dorado County, conforming loan limits go up to $766,550. Years ago, the standard guideline would be 33% for the housing ratio and roughly 38% for that total debt to income ratio. Now, over the past couple of decades, we have had the benefit of something called automated underwriting. And these are underwriting engines that were developed by Fannie Mae and Freddie Mac. So the world of technology and computers, we can run our scenario through the automated underwriting engine, and it's looking at the overall profile. It's not only looking at the debt and income ratios, but it's also looking at the savings, it's looking at the credit, it's looking at the job stability, it's looking at the overall picture of this loan. And in doing that, in a lot of cases, it will allow us to go much higher on those debt to income ratios, the housing ratio and the total debt to income ratio. It's allowed for a lot more flexibility than we ever had before those systems were available. And it kind of gives a security blanket to the underwriting team, knowing that they have a saleable loan if it meets those guidelines and we get an automated underwriting approval. It'll say approve eligible. So typically, I'm going to give you what I most often see. I most often see that housing ratio can go up to 43% fairly readily. And I see the total debt to income ratio that needs to be below 50%. So often we're stretching to 43 to 50% on that conventional conforming product. Now, if you're doing a jumbo loan, which is a loan that's above 766,550 in my area, so loan amounts above that are considered jumbo, and those jumbo underwriting guidelines are much more strict. They tend to be closer to that housing ratio of 33%. And then often I'll see the back end ratio, they don't want it to exceed 43%. So if you're looking at a jumbo loan, often depending on where you're at with your loan amount, your loan officer, if those debt to income ratios are exceeding that, may need to do some research to find alternative products that will allow for a higher debt to income ratio. They might also say, hey, let's consider doing a conforming first and get a second, right, to get us up to that higher loan amount. Maybe we're trying to get to 850 or 950, but our ratios are a little bit higher, and we're going to have a difficult time getting an approval through the jumbo underwriting. Well, then that's the case, what they're working on for you. So just to give you a little bit of insight, if for some reason your loan file is not acceptable to be underwritten automatically through the AUS systems, Fannie Mae, Freddie Mac, then the underwriting ratio guidelines tend to be more strict. And you're looking closer to that 33, 38, not exceeding 43% on that total debt to income ratio. A lot of times that's the case. Let's talk about FHA loans. Their standard guideline is 29/41. And when we do an automated underwrite, often we far exceed that today. And what I most often see is that housing ratio pretty much right around 44 to 45%, not over that is what I see most frequently. And then I see the total debt to income ratio going as high as 55%. Sometimes it can go a little bit more. It just depends on the overall profile of that file. But I want to give you a general idea of what I most often see when I'm running an automated underwriting. Now, if you're looking at a manual underwrite, then you're going to be closer to this 2941. Some cases we might get up to 45 or 50, but we're going to need some compensating factors: time on the job, savings, maybe your payment's not changing much. There's a whole bunch of guidelines that we have to adhere to. So this gives you a general idea. VA, typical ratio guideline is 41%. To exceed that, doing an automated underwriting, I often see 50 to 55% as fairly typically being accepted through a VA automated underwriting engine. And one of the things when we're doing a VA transaction is we also do something called a residual income analysis, where they're actually looking at your net income after taxes compared to your expenses. So there are nuances in all of these. This is to give you a general idea about debt to income ratios and what you can anticipate. First-time buyer programs. So I'm going to talk about the California Housing Finance Agency programs because I think it's one of the best down payment assistance programs out there. They typically, the housing ratio, we still have to, just like a conventional loan, we still will run it through an automated underwriting engine. So those rules apply, but they also have a total debt to income ratio that they'll say, hey, you can't exceed this. And so typically it's below 50% if your credit score is 700 and higher, or higher than 700. If it's below 700, then typically they'll limit that debt to income ratio to 45%. So pros and cons, and some of the things that your loan officer may be working on with you on your file. The Golden State Finance Authority products and programs typically will allow us to go up to 50%, and they have something called their golden opportunities that will allow us to go up to 55%. On all of these programs, they do change from time to time. So know that when you're working with your loan officer, like if it were me, I double verify these things on the, what's current at that time to make sure that we meet all the parameters that we're going to be able to qualify for the loan that we are working on. These first-time buyer programs can be conventional based or FHA based. And even though FHA might allow a little bit higher debt to income ratio, when you get into the first-time buyer products, they have some specific guidelines that say, hey, you have to fall within these parameters. And even if you got an automated approval that allowed for a higher debt to income ratio, the program guidelines for that first-time buyer program itself says, no, you must remain at below 50 or at below 45. So just, there are nuances and I want you to be aware of them. Now, ways to improve your debt to income ratio. So paying down debts. Let's say you had a car payment that was costing you $300 a month, but your monthly, your balance on it was $5,000. And let's say you had some extra funds. Paying off that car debt of $300 is going to give you quite a bit of improvement on your total debt to income ratio. And in some cases, it will make the difference between qualifying for that price and home loan that you want and not qualifying. So when you're working with a loan officer, they're often going to ask you, right? They want to get your credit. They want to find out how much do you actually owe and what are the payments. If it's a credit card, what's the minimum payment? And part of the reason for wanting to find out all that information is so they can best advise you how to accomplish your goal of qualifying for XYZ sales price. That's one piece of the puzzle. Next piece of the puzzle is, well, hey, can we increase our income? And there are home buyers out there who say like, well, hey, I'll just get another job. I'll get another part-time job, make some extra money, and I'll use that for qualifying. And that's great. However, beware, I keep mentioning qualifying income because lenders have rules and guidelines on what they'll allow us to use to qualify. And typically, when you have two jobs that you're working at the same time, um, loans have been analyzed in the past, why they went bad. And years ago, people did this and they got a second job. They worked it for 6 months. They bought a house. And then it wasn't sustainable to work all those hours on those two jobs. And it became a reason why they couldn't make their house payment because they couldn't work the two jobs. They left it. The house payment was too high. They got themselves in trouble. And now we've got problems. So lenders have come up with a guideline. When you're working two jobs at the same time, they want to see a history of 2 years of working two jobs at the same time. Doesn't have to be the same jobs, but it does need to be a 2-year history, right? So a 2-year history of working two jobs at the same time. They average that income and they come up with, quote unquote, your qualifying income. If you're a commission type employee and all of a sudden you're making a bunch more on commissions, typically the lender is going to require that we average that again over 2 years. So this is another reason why you want to get with a loan officer in advance of actually looking at homes and falling in love with a home, because we want to find out what we can actually use as your qualifying income to nail down that total debt to income ratio. Because when we're running those automated underwriting engines and maybe pushing that ratio up to the max, that's typically what I most often see, that can become problematic if we don't have that income calculated properly. And that's why I always recommend in advance, and you're going to find loan officers are more than willing to meet with you well in advance of you actually buying a home. I sometimes meet people with them and talk with them, go over, help them get fully approved. Could be a whole year in advance of them actually purchasing a home. But it gives us a clear vantage point of where they're at and what the qualifying income is that we can use to get them qualified. Let me see if there's any questions. If not, we'll keep moving forward. I hope that helps you understand the debt to income ratio calculation. And of course, it's more than just your debt to income ratio. We're looking at your overall picture. So your credit score, your savings, and your job stability all play vital roles in this qualifying process. And, if we are kind of minimal on our savings and our credit score or our credit profile isn't exactly, stellar, up to snuff, then these housing and total debt to income ratios, we may not still get an approve eligible. It might have to come back yet because the automated underwriting engine is not comfortable with what they're seeing. So that's also a factor in this whole process. I would love to help you tackle the pre-approval process and help you get a conditional approval so that you are fully qualified for the home that you want to go after. Always more than happy to sit down and talk with you. We can have a cup of coffee and go over what's going on. I'm a person just like you. I've struggled to be able to buy my first home. I know the ins and outs. I know ways to improve things and improve your situation so that you can go from being not a homeowner to becoming one. And that will change your financial future and put you in a great position to build your wealth. My name is Mark Teran. your mortgage man since 1986. You can get in touch with me. My cell phone is 916-768-6530, text or phone call, or you can email me at mark.teran@apmortgage.com. I hope this was helpful for you. If you liked it, please hit like and subscribe, and see you next time.